Hello and welcome to another in the series of Alpha educational videos with Elliot Omenson and
Nathaniel Vossman.
Today we're bringing to you the ever exciting quandary: dividend versus growth investing. Which one actually builds more wealth? And today we're going to do a little role reversal, which, I've heard is healthy in relationships.
Just a little bit of role play.
Yeah. So I'm going to ask Nathaniel the questions, since he's smarter, more educated than I am, and he's going to answer them. So what do you think of that? Are you excited for that?
I think it sounds like fun. Let's do it.
All right, well, let's just start off with the basics. What is actually the real difference between dividend and growth investing?
So dividend growth investing, it's like two different objectives. So some people might invest into stocks that provide, pretty healthy dividend. Because a company can take basically their income, at the end of the year,
Their earnings, their net profits.
Yeah, exactly. Well, they take their profits, and there's a couple things they can do with that money. They can either redistribute that money to shareholders in the form of a dividend, or they can take that and reinvest it into the company to grow the company. So that's kind of like the growth aspect. So,
or funnel it overseas and hide it from taxation.
Yeah, maybe that too. So that's why you see most of these tech stocks, they don't really have a big dividend yield because they're reinvesting for growth.
Yeah.
Where you get a lot of these big blue chip stocks that provide, a healthy dividend, something like
Coca-Cola,
4%. Yeah.
Johnson & Johnson.
And so there's people out there that want to invest in dividend stocks because they see it as an income stream. So let's say you got, for easy math, 100 grand invested, and the 100 grand is invested in a variety of companies, and it's yielding you 3% dividends each year. You get paid $3 grand in dividends. And you could see that as potentially a form of income, whereas other people might invest in growth stocks, so they're not really receiving that dividend, but the expectation is the price of the stock will increase. And so both forms, whether you're investing in a growth company or a company that's, providing dividends, it's really just taken into the bigger picture of just total return. And I think that's something that people get kind of twisted up. They see dividends as income, but in reality, it's just a return of money.
Right.
So you might get less return, less appreciation in stock price.
Yeah.
But you're making up for that with dividends.
Gotcha. All right, that's an excellent explanation.
Something like that.
Yeah.
I don't know.
Yeah. So the question that would pose is, are dividends actually creating new income?
Yeah, like I think this is something that a lot of people might misunderstand. It's because yes, it is income, and you do pay tax on it. But at the same time, it's really not any different than if you're investing in a company like Nvidia, Google, Meta, ones that don't really pay a big dividend, but those companies could appreciate in price. And so with something like Coca-Cola, yeah, you're getting that dividend each year, but you could be just invested in a growth stock. And if you needed money, what you can do is just sell your stock.
Right.
And the tax treatment, and we'll kind of get into it, really ultimately ends up being the same. Like, depending on how long you hold it, it might be taxed as ordinary income, or it could be taxed as long-term capital gains. And dividends are taxed virtually the exact same. It's just a different holding requirement. So yes, dividends are providing income, but not in as substantial a way as I think some people realize.
Gotcha. So yeah, because what happens when the dividend is paid out to the price of the stock? Anything?
Yeah, so it generally would, drop the price of stock the same relative amount, like if they're paying the dividend. And I think the bigger picture too is just seeing how your returns look year over year and over multiple years if you're holding that company. So let's say it's going up 5% a year. You're getting a 3% yield. you're really getting 8% return on your money. You can be reinvesting that dividend into the company, or maybe you're taking that pay and using it for actual income.
Yeah.
But the net effect really isn't that much different than if you're just in a growth stock. And these are conservative numbers, but a growth stock that appreciates 8% in price and they don't pay a dividend.
And you could just sell 3% of it that you're going to get your 3%
exactly.
income.
And it's taxed pretty much the exact same way.
Yeah. Yeah. So I like what you put here. It's like cutting a pizza into more slices. It's the same total value.
Yeah. Yeah. And so to me, I think the big message from this video that I'll kind of hit on multiple times is that, you know, whether you're getting dividends or you're getting stock appreciation, it really doesn't make a big difference. I think dividends just get such a big name because it feels like an income source, just the same way as when you're investing in bonds, it feels like an income source. But, you know, at the end of the day, you invest $100,000, you want to see your money grow, whether it's providing dividends or a yield or just an appreciation in stock value. It's all kind of doing the same thing.
Yeah, yeah. So a lot of people know I have two brothers. They're both financial advisors. And my brother Glenn coined the greatest line I'd ever heard. This pretty large firm was bringing them on board, and they, I guess, they kept getting caught off guard by like things that they didn't know, because they've been paid a lot of money. I'm talking almost 7 figures to come work for this firm as a sign-on bonus. All right. And finally, my brother Glenn had enough of somebody. He turns around and goes, "Look, you know what I know? I know 10's bigger than 8. And that's all I need to know."
That's the truth, to be honest.
Yeah. And so I think what you're hitting on is people get so caught up in all these nuances and stuff. But at the end of the day, what matters? Is 10 bigger than 8? Did your portfolio grow more than this other portfolio? Are you getting the return that you want? Does it matter how you're getting the return? If
Not
all
really
things being equal, if the tax treatment is the same, then why are you trying to do all these shenanigans?
Yeah, exactly. And then also, it could be argued that those dividend stocks would be a net detriment just because it's almost like forced income, meaning like,
yeah, because if they issue a dividend, you don't have control over.
Exactly. Like if it's in a taxable account, you get that dividend, you're going to be taxed on it. Whereas if you're just invested in growth stocks, if you need income, you can choose when you want to take that income out. You can sell a share, 2 shares, a certain dollar amount of shares. You have a little bit more control. Whereas a lot of these stocks are paying quarterly dividends, and you're kind of just stuck paying tax on them if they're in a taxable account.
But let's talk about the biggest draw to dividend producing stocks. In my mind, as a financial advisor, when I've talked to people that want them, there's one primary reason people want them. And it's safety. They view, right? So you have dividend kings and dividend aristocrats, right? And a dividend king is a stock that's produced an increasing dividend for 50 straight years without fail. A dividend aristocrat is a stock that has produced a increasing dividend for 30 straight years without fail, right? So for a company to do that, right, that's a pretty solid corporation.
Oh, definitely. Right? That's why you get the big companies like Coca-Cola. They've been around forever.
They're global.
And they probably will be around forever because they got their hands in more stuff than you even realize.
Yeah, you got no idea how much stuff they got, right? Johnson & Johnson.
Yep.
Right. And so is dividends investing actually, well, and then I want to go on one other aspect of that. One of Warren Buffett's favorite types of businesses to get into are what's called moated. They're moated businesses, right? Meaning there's a natural moat around the business, right? And there's a significant sector in the dividend world that is wildly moated. That's your utility companies, right? They have a built-in client base. They can't go anywhere. There's no competition, right? There's been some laws changed over the last couple of decades to try and create competition. But even then, it's like, what? You got this energy company to buy electricity from that energy company. It's not like there's 10 different options, right?
Exactly.
So they have these built-in client bases. Unless you're in a blue state, they're growing.
Yeah, fair enough.
A little political hate joke there. Right, because cities just keep growing and growing because people keep coming.
Yep.
Used to be able to say people keep having babies, but that doesn't really happen anymore. So you would think a moated business like a utility company kicking off a Dividend or a Johnson & Johnson or a Coca-Cola, these are well-established global footprints or moated footprints, protected, client base built in. They've been producing dividends for 30 to 50 straight years. Is that not safer than investing in growth?
Yeah. Yeah. And my opinion would be that, yeah, if you're doing it correctly, I would say it probably is safer. But then you look at those big companies and you look at the total return historically, at least in recent history, like a Coca-Cola, like maybe they had more stock appreciation in the past, but your total returns are going to be maybe a little bit lower because the stock appreciation is really not that notable. And even though they are paying a pretty healthy dividend, it's not like that big.
Yeah,
it's like a few percent maybe.
Until Elon colonizes Mars, Coke doesn't have a new market.
Yeah. And so, yes, to a certain extent, if you're investing in big companies like that, I would say it is safer with the trade-off of your total returns can be a little bit lower. But there are other companies that might have a much higher dividend yield, and that's where you start getting into a little bit of risk.
Yeah, you start chasing that high div.
Yeah, so you start looking at the dividend yield, and you start seeing 4, 5, 6+%.
Oh, 8.
Yeah, even 9. Higher. Like I've seen double digits and even higher, and that's where it gets a little bit more risky, in the sense that you're probably not going to get continuing growth on those dividends. In fact, the company has no obligation to pay dividends. And so those companies with such high dividend yields, you might see that and it looks incredible. And if they really paid that every quarter, it'd be great. But like I said, they don't have to pay the dividend. So they could just cut the dividend off for a quarter. They cut it off for a year. They could just never pay another dividend again. There's no contract.
Yeah.
Whereas
it's not like a bond.
Yeah.
That it's a contractual obligation to pay a yield.
Exactly. Because these are equities. And so
they're only paying a dividend when they have excess profits and they need to disperse them and they don't have something to spend on.
Exactly. And even if they do have excess profits, they don't have to pay it out as dividends. They can keep it within their company. They can reinvest it.
Buy their stock back.
Exactly. So
funnel it to a
I would
Somalia
say,
learning center.
Yeah. I would say yes. If you are conservative, you can do it, and it can and probably will be a safer play. But yeah, you would be probably trading total returns over the long run.
All right. Well, now let's get even more technical.
Okay.
Let's keep pushing your knowledge base here. How are dividends taxed compared to growth? Equity growth.
Yeah. Yeah, so dividends are taxed two ways, very similar. In fact, it's ultimately the same tax treatment as stocks, just different holding requirements. So on dividends, there's qualified dividends and non-qualified dividends. And this is really just mostly referring to how long you're holding the stock. So there's a date called the ex-dividend date, and that's the first date after which you can't just buy the stock and get that dividend. You have to own the stock prior to that date in order to get the dividend. But also, you got to factor in the tax treatment. So if you just buy the stock the day before the ex-dividend date, and then you sell it 10 days later, you get the dividend, but the dividend is going to be taxed as ordinary income. But if you buy it prior to the ex-dividend date and you hold it for over 60 days, then it's going to get more favorable tax treatment. And so similar long-term capital gains, it's the same tax brackets. So 0, 15, 20%. And this applies to all American companies and most other major foreign companies. So it's really that holding requirement. But then otherwise the tax treatment would be ordinary income or those more favorable 0, 15, 20%. Yeah. And the tax brackets on that are the same as long-term capital gains. But, like I was talking about earlier, it's still like basically a forced tax. Like if it's in a taxable
because you don't control when you get the dividend.
Yeah, you're gonna most likely quarterly, and you're gonna be paying that tax. Whereas if you're holding on to a growth company and you're really looking at stock appreciation, it's taxed the same way. Short-term capital gains, ordinary income, so less than a year, you're holding it. You sell it, your taxes ordinary income.
Yeah.
And then if you're holding it beyond a year, it's a long-term capital gains.
Gotcha. So basically, with dividends, you would say the tax decision is what?
The what?
The tax decision is, with dividends, the tax decision is made for you.
Yeah, exactly.
But with a growth account, the tax decision you get to make.
Exactly. And ultimately ends up being the same. And I think that's the big picture of it, is that.
But I think control combined with other strategies, it makes it not the same.
Oh, yeah, exactly. Like I think all else equal, you'd rather have the control versus not.
Yes.
Definitely.
Right? So let's say I didn't want dividends, right? I didn't want to be in these like super stable companies, or I didn't want to go into utilities and try and chase high yields or high dividends. Can I create income without bonds or dividends or a job?
Definitely. Definitely. So this is where the greater control comes into play. You can be invested in those growth stocks, and really it doesn't have to be a growth stock. It could be really any ETF if you're choosing, really any selection of stocks. But instead of relying on a dividend to provide that income, you can just sell your stock. You can just sell your ETF. If you need 10 grand a month, you just set up to sell 10 grand of the ETF or 10 grand of whatever portfolio you're holding. And that's income. Like it doesn't have to come in the form of interest payments on a bond, or it doesn't have to come in the form of dividend payments from stock. You have the ability just to sell your stock.
Right.
And that provides income to you.
Right. And would you say the market is very smooth or volatile?
I mean, in general, probably, it's always volatile. So.
Right. Yep.
Yep.
So do you think if I was managing my own portfolio, there's plenty of opportunity to sell when the market's popped up?
Yeah, I would say so. You could always trim off, take profits whenever, stocks are up, and maybe hold off when the market's down.
Right.
Yeah.
Kind of keep an extra cushion on hand so I'm not forced to sell.
Yep. I think this plays into our little time bucket strategy.
Right.
Very well. And I think it's a beautiful concept, like always having some amount of cash on hand, depending on your risk tolerance. So that way, when markets do go down, you're not having to sell those stocks at a loss, or just at least when they're down significantly. You can just pull money from cash or your cash equivalents, use that as money to spend. And then when the markets pop back up, that's when you go back to peeling off certain amounts whenever you need that money. So I think that's where the whole idea of greater control comes into play, is that you're not forced to ever, be taking the income.
Yeah. Well, so what if I don't need the income and I've decided to build a dividend portfolio and it just keeps kicking out dividends in my account? What do I do with them?
Well, what happens to them? You can set it up to reinvest. So you could just reinvest right back in the same stock if you want to keep building that position, or you could, use it to buy other stocks if you're wanting to. Or at the end of the day, you can do the best thing and just spend your money, have fun with it.
That's my favorite thing to do with money.
Yeah. And so, but the whole idea of reinvesting those dividends in a taxable account, though, does drag your overall performance.
When you say taxable account, let's just be clear. If you have like a non-qualified account, an account that's creating long-term capital or short-term capital gains, usually those are titled in your name as an individual. It might be called an individual account. Some people call them a brokerage account. They might be titled in the name of your living trust.
Yeah.
Right? That is a non-qualified account. That is a taxable account.
Yep. Yeah, you're gonna see some pretty serious drag in your performance.
Yeah, and so you're burning taxes and reinvesting the difference.
Yeah. And so it's.
But if you had in that same kind of account, if you were invested for growth and your account was growing, you're not paying the taxes unless you sell a position.
Yep.
This is very important.
Yep. Definitely very important.
Okay. So, and so I thought this was a really important thing to point out that you put down here, even if you reinvest dividends, you still owe the taxes.
Yeah, exactly.
Right.
So it's like, yeah, in those taxable accounts, it's a big tax drag. But, maybe a better place to hold some of these dividend stocks is in a qualified account, whether that's 401k, like a Roth IRA, a regular IRA. Like that way, when those dividends are paid out, you're not paying tax on it.
Yeah.
Like in a tax deferred account, whatever income you ever pull, whatever money you pull from that account, it's just deferred. You're deferring those taxes, so you're just going to pay, your taxes at ordinary income rates when you pull money out.
But you're getting to get growth on the tax portion.
Yeah. So at least when you get dividends in that case, you're not getting taxed on the dividend then. And so whether you want to reinvest it in that stock or reinvest it in another stock, it's at least not, dragging your portfolio down, or at least slowing it down by having to pay tax every time you're getting dividends.
Yeah.
So it could be argued that having dividend stocks in a qualified account is probably a smarter place than a taxable.
Yeah, I agree with that. So you would say dividends aren't necessarily the problem.
No.
Where you
hold them, yeah.
That's
definitely
the problem.
Yeah, so that can make a big difference, especially, when you have, a really big amount of money, that.
Yeah, well, just think. There's investors out there that have a problem with a 1% asset management fee. But then they're burning 10, 15% because they have this portfolio set up incorrectly.
Yep.
And in the wrong kind of account.
Yeah, they're burning.
And I would imagine a 15% tax on your gains, it might be, I'm not very good at math, that's why I'm a financial advisor, might be worse than paying an asset management fee to somebody structure everything properly for you.
Yeah, yeah. And, the dividends, it might be, that's a portion of your total return, so it's not a complete 15%. But
no.
It would probably end up, netting maybe more than a 1%.
Yeah, it might be. It might not be. I don't know the math.
It definitely is a tax drag, and it's one that, it's not only that, but it's just one that could easily be avoided. And that's the thing. It's you got to have the proper planning in place to avoid things like this. Because some people, they see that and they just put it in they just buy it in their taxable account. And at the end of the year, they get hit with a larger than expected tax bill because of it.
Yeah. So which one do you think allows for better compounding? Which I think you've already stated it, right? Receiving dividends, reinvesting the after-tax amount, or just being in a growth account?
Probably growth. I mean, it's not like there's no 100% right answer because, if you're investing strictly in growth stocks, like ones that are heavily reinvesting, those stocks are going to be more volatile. And so in a down year, those dividend stocks probably won't go down nearly as much. But, when the market's booming, you're certainly going to get much, much more return on those growth stocks than you would those dividend stocks.
Yeah.
So I would say over the long run, your total return is probably going to be higher, not due to the dividend investing.
Gotcha. Well, is there a time when you would be meeting with a client and you would say a dividend portfolio absolutely makes sense for you, and as a fiduciary, I would say this is what you should do?
Yeah, at the end of the day, clients, if they have preferences, dividends are not a wrong answer by any means. And so if you're invested in a portfolio with these dividend aristocrats or kings, that's a pretty reliable dividend, very reliable. And so if you got a lot of money invested, you're pretty high net worth, and you're really focused on just security and then just a pretty consistent income stream, then yeah, you can do a dividend play, and you could be fully invested in dividends if you want to, and just have that money be your spending money. There's really nothing wrong with that inherently.
I got a question for you. Let's say I buy into Coke or something, and it's at $30 a share, and the dividend is $2.
Okay.
And that's probably wildly off. I didn't look any of this up. I'm just literally making up numbers.
Yeah, it's within the realm of possibility.
Yeah. And a year later, something's happened to the share value of Coca-Cola. It's now down to $20 a share. But they still pay out the same $2 dividend.
Yep.
How does that impact things?
Well, your net worth is going to drop because, the value of the stocks you
30%.
own, have gone down.
Mm-hmm.
But
is that even possible? Is it possible for a dividend for a stock to lose 10, 20, 30% of its value, but still pay the same dividend?
Yep. Yeah, it's definitely possible. That's when you start getting a little bit into riskier grounds because, like I said, that dividend is not something that they have to pay. And so if a company is struggling and they're down because of bad earnings reports, bad projections going forward guidance, those dividends might be at risk.
Yeah. Okay. Well, let me change the example. Well, I'm just having fun here.
Okay.
Let's say I'm Budweiser.
Okay.
And let's just say I hire a woman with a degree in intersexual, racial, and gender studies to be the head of my marketing. And this would never happen, right? But let's just imagine. And they pick somebody to represent their brand that is the antithesis of anyone who would ever enjoy a Budweiser.
Purely hypothetical.
Purely hypothetical. And so their stock takes a hit completely unrelated to actual profits and whatever.
The actual health of the company. Yeah.
Yeah, right. Do I really care as somebody who bought it as a dividend producer?
Not too much. And then maybe you might even, if you like the company, maybe that's a great time to throw a little bit more money at it.
Yeah, because my dividend is coming to me, right? So I own, let's say I bought in and I bought 100 shares and it was 30 a share. The price goes down to 20. I still have 100 shares.
Yeah.
If they produce the same dividend, I still get the same dividend.
Yeah, your income would still be the same, and especially like a big company like that. Yeah, and in fact, that company may still increase their dividend, but at a minimum, yeah, you probably can get the same total dollar amount. And if you like the company, maybe you buy more of it, and then you can lock in an even better dividend yield.
Yeah,
in this case.
Yeah, well, yeah, because that'd be really incredible, right? If the stock value take 20% or something due to something that might be unrelated to the overall long-term health of the company, that's a great time to buy more.
Yeah. So when share price goes down, the dividend yield goes up because the dividend yield is just like the annual dividend divided by the
it's the
price of the
percentage.
stock.
It's a percent, not a dollar amount.
Yeah,
you have the
exactly.
dollar amount, but then you have
Exactly.
what that equates to in terms of the percentage of the value of the stock.
And so, maybe the dividend, I'm just throwing out random numbers again, but like maybe the dividend on a stock is 4%, like a 4% yield.
Yeah.
But then the stock drops a certain amount and then it goes from
to 6
4,
to 8
it goes to 5 to 6.
Yeah.
But if it's a pretty healthy company, like, Budweiser or something.
It's not like they're going anywhere.
The dividend's not really going anywhere. So maybe you buy more, and then that way, the amount of money you're throwing at it, you're getting ultimately a higher dividend yield, and you're locking that in. And then more likely than not, the stock will just appreciate right back up to basically baseline. So you're probably going to get locking in a good dividend yield, and you're going to see some appreciation in the stock price. So kind of a win-win.
Yeah. All right. So what do you think the biggest mistake investors make with dividends?
I would say a couple. First off would just be the idea of thinking that dividends are the only income play and not realizing that you can just
create your own income.
Create your own income by selling shares.
Yeah.
So I would say that is probably number one. And then the other one is getting in to a little bit of risk by chasing high yield dividend stocks. Because if you're seeing something like 8, 10, 12% dividend yield, it's probably not going to, either they're not going to be paying those dividends long term, or it's going to be inconsistent, or they can change the dividend amount. And so you're chasing something because it sounds good on paper, but some things sound too good to be true. And in a lot of cases, I would say that's the truth there.
Yeah. All right, cool. Let's see here. What other questions do we got to pepper you with?
Let's see it.
I like this one. Yeah. Okay. Well, let's just wrap that point up because I really like these quotes you've made. A high yield isn't always a benefit. Sometimes it's a warning sign.
Yep.
Right?
Yep. That is true. That is true.
Right. So these last two I'm just going to do together because I really think they go really well together. And that's just what's the smarter way to think about it overall? And then I think that leads perfectly to what's the main takeaway of this video.
Yeah. So I think the smarter way to look at whether you're doing dividends or growth or however you're investing into equities would just be to focus more so on your total returns. Quit thinking about it as dividends. Quit thinking about it as stock appreciation. Just think about it as total returns. So you invest $100,000 and you're getting some dividends, you're getting some stock appreciation. Take a higher, zoom out a little bit and just see how much your money has grown. Because that's all that matters at the end of the day. Is your return on your dollar.
Yeah.
Because I think everyone can agree upon that. Like, if you're going to invest $1, you want it to grow as much as possible.
Yeah. Do you really care how?
Yeah, exactly.
Like I
Whether
ask
that's
that people
for dividends
all
or
the
not,
time.
it doesn't matter. I
Like-
just want my dollar to grow.
Yeah. I just want 10 to be bigger than 8.
Yeah.
That's it.
Exactly. So I would say, yeah, just take a more simple viewpoint on it. See how much you're getting in returns, and then do your best on the planning side to minimize the tax burden of it, and you're golden.
Yeah. Yeah. So one thing I say all the time to people is I love the question, is X a good investment? I believe there's only one correct answer to that. Compared to what?
Yeah.
That's it.
Yeah.
Compared to what?
Yeah.
Right. And again, all that back to this bigger picture needs to be thought about in terms of, and I think this is true in every area of life, right? I think people get distracted all the time. They lose sight of what is your number one most primary goal, and are the things you're doing leading you to that goal or not? And if they're not, why are you doing them?
Exactly.
Right? Now, that doesn't mean it's not okay to go off the reservation and have a little bit of fun every now and then, right? But think about your plan and think about the investments and your strategies. Is it all in pursuit of your goal? What's your goal? What should your goal be? And I love what you put the goal. The goal is not income. It's what? It's after-tax income that you control.
Yep.
I could have $100,000 a year of income, but if I'm burning half of it to taxes, or I could have $80,000 a year of income and not pay any taxes.
One's bigger than
Again,
the other.
10's bigger than 8,
Yep.
right? 80's bigger than 50. This isn't rocket science.
Yeah. So, yeah, at the end of the day, people are investing money for one reason. That's so they can retire and live well in retirement. And so who the hell cares if it's dividends, growth, whatever it is.
Yeah.
You're just trying to make the most of your money and do so by investing correctly and allocating everything correctly to minimize taxes. And that way you can just live life in retirement and not be so worried about money.
And I think it applies even to fees.
Yeah.
Like, what if my fee was 10% per year, but your net after-tax income was double what you could get anywhere else?
Yeah.
I mean, is it really, what does it matter?
Yeah.
Right?
Yeah. Again, it comes down to the idea of just your actual returns, whether it's after tax, after fees, you're trying to maximize it. So yeah, you kind of got to look beyond an AUM fee, look beyond, how you're investing and just see what
is
total
your
return
net
is, how much money you
tax?
actually have to use in retirement. That's the only thing that matters. Only thing.
And so I love your closing line because you almost wrote the title of my book.
Almost.
The goal isn't just to generate income. It's to keep what you've earned.
Yes.
You said keep as much of it as possible.
I like keep what you earn. That's a lot better.
I'm rewriting it for you. It's to keep what you've earned.
Yep.
Right? And I thought this was fantastic. I thought you did a great job.
Yeah.
This is one of those topics that I switched on you just because I felt like you had know more about
It's
it.
a fun one.
Yeah. And you had a really good grasp of all these things. So I appreciate you letting me flip it on you and be the one to ask
It's
questions.
always a good time.
And so until our next video, this is Elliot
Nathaniel.
signing off. Hope you liked it.